Hello and welcome to our Charter Hall Direct Insight series, the first for 2025. I'm Steve Bennett, CEO of the Direct business here at Charter Hall. Our Insight series is designed to provide you with the latest news on our funds and performance, as well as share insights into the Australian commercial property market. Today, I'll take you through some of the macroeconomic trends we're seeing, as well as touch on the valuation perspectives from the December 2024 quarter. I'm pleased to be joined by our Head of Research, Sasanka, who will provide key takeaways from our research paper on why Australia, and he'll focus on the longer-term market outlook. Before we go any further, an important reminder that the information in today's video should not be taken as financial advice, and you should consult your financial or other professional advisor in anything that relates to your own personal investment situation. We also encourage you to read the relevant offer documents in full, paying particular attention to the product disclosure statements and investment memorandums. So starting with the macro environment, what's been happening recently? Well, we've seen CPI and inflation rates stabilise. We've seen the first reduction in interest rates by the RBA in a long time, which occurred in February. And what it all means is that we've reached peak interest rates. Looking forward for its impact on commercial property valuations, we expect a declining interest rate environment to be broadly supportive of long-term valuation movements for commercial real estate. However, it doesn't happen in a straight line. Initially, what we expect to occur is that as market rents and lease rents increase over time, you'll see a gradual movement in valuations, and then in future periods, the potential for capitalisation rate reductions. So not only has Australia recently reduced interest rates, but let's look at Australia compared to other major global economies. Up there on the screen, you can see 5 other large economies throughout the world. And what stands out when you compare it against Australia in the bottom right-hand corner is how much quicker and how much larger the movements and reduction in interest rates in other parts of the world. Whilst this doesn't guarantee future interest rate reductions in Australia, it does lend credibility to the market's view that there will be further interest rate reductions in Australia over the next 12 to 18 months. So moving forward, what does a declining interest rate environment likely bring to the valuations of commercial real estate? Up there on the screen, what it shows is that we've had the most savage reduction in valuations in 15 years, in fact, since the GFC. And this chart is an average of all the core prime real estate sectors. So it is slightly different depending on whether you're talking office, industrial and logistics, social infrastructure, or retail. However, pleasingly, this average showed the first signs of uptick in the recent valuations. And whilst we're very reluctant to make forward-looking predictions on valuations, what I will say is it is positive that the valuations on average have begun to tick up. So now moving on to the valuations and what we observed across all the core real estate sectors at December 24. And remember, Charter Hall has over 1,600 assets, and we've got the vast majority of these independently valued, meaning we have a great access to data and trends that are playing through the market. In the industrial and logistics sector, you saw capitalisation rates be either flat or very marginal movements. Pleasingly, the market rental growth was more than enough to offset these capitalisation rate changes, meaning that on average, the valuations were either flat or showed slight uplifts at the December valuations. Moving now to the office sector. This was the core real estate area we thought would reach valuation bottom last. And as it turns out, that is what we've observed. So valuations range between 0 and -5%, depending on the asset, the tenant profile, and asset-specific characteristics. Pleasingly, the rate of capitalisation rate increase declined materially, and it was partially offset by market rental growth. Looking forward, we're seeing a favourable investment environment for office, with forward-looking IRRs and return profiles as favourable as we've seen in a long time. Wrapping up the valuation movements which we observed at December, I'll close by talking about convenience retail. In this bucket of assets, we include things like pubs, service stations, neighbourhood shopping centres, as well as Bunnings. Pleasingly, they reached valuation bottom in June 2024, and at the December valuation process, we witnessed either flat or small uplifts in valuation. Capitalisation rates have stabilised, and we're now seeing the first signs of valuation growth driven by market rents. So wrapping it all together, we've got a supportive macro environment, but what does it mean for our funds? Well, up there on the screen shows the benchmark return in grey and what each fund has delivered in terms of total return in blue. Pleasingly, 8 of the 9 funds have exceeded their benchmark since inception. However, we do acknowledge that the performance has varied considerably depending on the underlying sector, as some sectors, as I just mentioned, were impacted more than others in terms of valuation. Looking forward, we're seeing opportunities in the market to pick up assets at great prices with forward-looking return profiles that exceed long-term expectations. Now, rather than me diving into the specific details on every fund, we encourage you to explore our quarterly report or visit charterhall.com.au for a comprehensive overview. So today, I'll just be focusing on 3 key funds from our direct suite and highlighting essential insights for our investors. So the first fund I'll go through in some detail is the Charter Hall Direct Office Fund. There's 2 key things happening right now with this fund. The first is its regular 5-year liquidity event. And for those who are looking to exit, just a reminder that that closes shortly on the 19th of March. The second key thing to note in relation to the Direct Office Fund is that we recently launched a $100 million equity raise. Units will be issued at a 2.5% discount to the prevailing unit price, and the offer will close once that amount has been raised. Moving now to the Charter Hall Direct Industrial Fund number 3. Not only has it delivered for our investors 13.2% per annum since launch, but investors elected to continue it for a further 5-year term. We look forward to managing this fund into the future and deriving further growth for our clients. The last fund I'll talk to is the Charter Hall Office Trust number 2. It should be highlighted that this is only available to wholesale clients. The capital raise will close prior to 30 June, and for those investors who are looking to access an office-only syndicate with exposure to 2 prime assets, one in Adelaide, one in Brisbane, this may be something that potentially interests you. But as I always highlight, please do speak to your financial advisor and read the offer document in full. I'll now pass over to Sasanka, our Head of Research here at Charter Hall. He'll give his observations and insights into the long-term trends in property, as well as focus a little bit on our most recent research paper, Why Australia?
Thanks, Steve. Over the past 4 years, commercial real estate sector returns have been dominated by the largest interest rate cycle in decades. The adjustment to higher rates contributed to the most significant valuation repricing since the global financial crisis. As we enter a new year, a broad range of cyclical and structural factors will drive upward pressure on asset values in land-constrained markets and sectors. Inflation has continued to moderate, given the Reserve Bank capacity to rotate towards expansionary policy. This will support economic activity, corporate cash flows, and drive consumption-led growth. Importantly, the Australian prime property sector offers compelling risk-adjusted returns. Yields are attractive compared to historical levels and offer high-quality cash flows with forecast equity returns at larger premiums to bond yields. And given the gains across the broader listed equity markets over 2024, real estate sector weightings are generally below targets, increasing the prospects for a material balancing towards property. Capital markets and a broad range of signals affirm the conviction and the outlook in the recovery, with many indicators at the strongest position since the onset of the inflation cycle. Transaction volumes have reached the highest levels since mid-2022. Broker and valuation forecasts supported by the increased transaction evidence point towards a stabilisation of cap rates. And listed market pricing over the past month traded at close to discounts to NTA and in many cases premiums to NTA. However, unlike previous downturns, construction costs have continued to rise. A shortage in labour and supply chain disruptions have contributed to this escalation, with many asset valuations well below replacement cost, even excluding land values. This continues to reduce the capacity for markets to respond to increased demand. Looking beyond the shorter-term cyclical volatilities, Australia's high-quality real estate should benefit from a backdrop of long-term economic fundamentals that continue to strengthen against the other major global economies. We explore this in Charter Hall's second edition of the Why Australia report. Australia's real estate sector has a history of generating higher returns at low volatilities. In this report, we prosecute the contributors to this outperformance and the key themes that underpin and transform the demand for Australia's real estate sector. Over the next decade, Australia has the strongest economic, population and employment growth forecast, between 2 to 4 times greater than the G12 nation. In a world with rapidly aging populations, Australia benefits from a younger and more productive population. The cities and economic opportunities have made it a leading destination for global talent. Amongst the other major megatrends underway, the AI-led transformation is shifting our real estate landscape. So that concludes my update for today. For more information, you can access our Why Australia research report using the link below. Back to you, Steve.
Thanks for that update, Sasanka. And that concludes today's Insight series. And thank you all for joining us. If you have any questions, please do get in contact with our team, whose details are up there on the screen. All of our fund information can be found in our quarterly report as well as on the website. Thank you very much.